I think what Neil's saying was echoed by something that Secretary Besant mentioned during a White House press conference, and he talked about President Trump using strategic uncertainty to what he hopes to be his benefit with a lot of these trade and tariff discussions. However, to Neil's point, that doesn't necessarily, when you're providing a lot of uncertainty that may benefit you on the trade and tariff side, that's obviously not going to be something that's well received by corporations looking to deploy capital.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script, where we will discuss markets, economics, policy, history, and life. It is the 2nd of May, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We're going to touch on a bunch of things this week, but mostly we're going to talk about the labor markets. We're going to talk about trade, and we're going to talk about what's happening in stocks. But, here in the Northeast, and I'm sure it's true countrywide, it is prom weekend here, so I'm gearing up for that. My date's really looking forward to using my AARP card at McDonald's. You remember your first prom, Steve?
I do. I went to an all-guys school, joke inserted, but we actually, because of that, had a lot of girls' schools proms to go to. So I actually went to 9 proms during my tenure.
Wow, it's a lot.
You're a stud.
Well, how many football team, which had a lot to do with it. So.
How many were followed up by trips to the police department?
Not I remember.
Well, the first weekend of May for me, which is 2 things. One is Cinco de Mayo, which apparently isn't that big a deal in Mexico, but for whatever reason, we like to celebrate it here in the States. But that is overshadowed for sure by the Kentucky Derby this year. Anybody a Derby devotee? No. So journalism, sovereignty, and Sandman are the favorites, but I am going with Luxor Cafe as the long shot, 15-1. We'll see where they go off. He is a byproduct of American Pharoah, won the Fakuro Stakes, and I think is priced as a value. So we'll see if you guys want to jump on your apps and get involved in that. That's the only thing to me that could be more important than payrolls on a Friday, the first Friday of the month. But Neil, begrudgingly, I'm going to turn it over to you. 177,000. Better, worse than your expectations, about in line, and work it into the cooling labor market. Helps, refutes. How are you thinking about it?
I think actually the labor market's still cooling. I mean, the jobs number itself was good, but if you look under the surface, there's enough evidence here, honestly, to suggest that had it not been for tariffs, the Fed would probably be thinking about cutting in May. If you think about the inflation numbers that came out recently, we had a very soft core inflation print. And if you look at wage growth in this report, it rose just 0.2% in April, with average hourly earnings up barely 2.5% annualized over the last 3 months. So the momentum under wage growth is cooling. The momentum under actual price inflation has been cooling. And there's clearly slack building in the job market. If you look at permanent job losers, that's going up. Permanent job losers tend to be hard to put back to work. And it's been rising fairly consistently in a very steady way. So there was a linear slowdown that was ongoing. And then you have a tariff shock. So you're taking a slowdown and, arguably making it worse. And so I don't think we're really out of the woods yet. I think the rates market is showing, fewer cuts being priced, which makes sense because people are kind of thinking it's about to be Armageddon. And I get that. But, I would just say the economy is not out of the woods and the Fed's not off the hook. And yeah, I mean, that's sort of where I'm at.
So when we look at it from the perspective of some of the other indications that you were looking at, I know that you've talked about the slowdown, but part of your call around the Fed right here is this difference between wage growth and the policy rate. You want to elaborate on that a little bit?
Well, so when you look at private sector wages and salaries, so when you take the sort of the sum product of jobs, hourly earnings, and the work week, I mean, that's not running at a particularly strong pace. It's actually running below the rate of the overnight Fed funds rate. And so what that basically means is the household's budget constraint is getting worse, and the Fed's basically sitting back and doing nothing. And we know why they're doing nothing, because they're waiting and seeing what's going on with inflation, right? And so that just means that you're not really shifting the nominal anchor right now, which makes it very challenging for consumers to absorb price increases. And if prices do end up going up, that's ultimately going to. I mean, it's P times Q, right? So whatever from tariffs goes into price will have to come out of quantity right now.
And the other one I think Secretary Bessent hit on this week is the differential between Fed funds and 2-year yield, which is something that we use all the time just to kind of understand how off the mark policy rates are, right? Because policy is not a market rate. Policy is a policy rate. These guys sit around and talk about it and look at data. And the market is kind of omnipotent and projecting what their expectations are. And that gap right now also would suggest that the Fed is too tight. How tight is the Fed on that score? Do you recall?
I think it's about at least 50 basis points.
Yeah, I think so too. And it's actually pretty unusual.
A lot of this also is a function of like expectations, right? Like the gap between the Fed funds rate and the 2-year yield is just really it's a forecast dispute, essentially. I mean, the Fed's basically telling you they have a different forecast of the economy than the market does, and you have to see who's right. I mean, there's a lot of, there's a lot of differentiation, I think, in the market. I mean, stocks doing what they're doing over the last week is very much at odds with the market's pricing of like 3 to 4 rate cuts, in my opinion. There's a lot going on. It's sort of, I don't think the Fed's cutting this much if stocks keep doing what they're doing. So it's going to be interesting to see how all that reconciles, I think, over the next 6 months or so.
Yeah, I would say just in the last, call it 2 weeks in particular, probably the most encouraging thing from my standpoint, from the market's message. And keep in mind, this is all happening while our models have us in a downtrend, right? So for us, we're in a downtrend. We don't yet have escape velocity. That's seen through some momentum measures that we use. We haven't yet been able to fire on that. But my concern around the recession story is that credit has improved and credit continues to improve. The double B versus triple B spreads are back to basically the point at which they broke out, say 6 weeks ago, 4 weeks ago, something like that. So the credit markets are certainly absorbing this as more of potentially a supply shock that's going to be mitigated as we go forward. Obviously, that has everything to do with tariffs, or most of it to do with tariffs and trade. But what do you make of the improvement in credit and, frankly, the stability that we've seen now in the dollar, the stability that we've seen in the 10-year yield, and this back off in gold?
I think people are betting on deals, right? I mean, I think that's part of what's going on here. I mean, if you're like, so basically, I see you had like this big sort of sudden stop risk event that happened. Not that I think tariffs were actually sudden stop. So you had like this big event that kind of happened in the market, sort of almost like a clearing event, right? And you had basically these data discontinuities in things like consumer and business confidence. Now what you're seeing is, okay, so that basically took out a lot of potential sellers, right? Then you had the Liberation Day announcement. That also took out a lot of people. That happened first, obviously. And what have we seen since? The economy is not cratering. I think it's still slowing, but it's not cratering, right? Like, so because the soft data cracked the way it did, you almost need like instant gratification, right? And you don't have that. So I think that's the first point. And then you basically have seen, fairly quickly, like a walk back of the reciprocal tariffs that were announced on April 2nd, right? I mean, it's, so I think that's kind of what's gotten the stock market enthusiasm back in. Now, I think the risk is, it just, to me, is that number one, people may have lost sight of the slowdown in the first place. Like, as an example, like today, like there were downward revisions of almost 60,000 over the last 2 months. And if you think about employment growth, like we only had like half the surveys come in this month. So that just tells you that next month we're going to see revisions. It doesn't tell you the direction, but revisions tend to be correlated. So the momentum going into all this is not as strong as people thought. So I think that's the first thing, is that we're going to get reminded at some point over the next couple of months that things weren't all that great to begin with. And I also think we're going to be reminded of, like, there are deals being done, but we're actually, I think, in some respects, losing sight of what's actually happening. Like, we actually have a 10% tariff baseline in place against our trading partners. That is happening. We're still talking about 145% tariff on China. Maybe that goes away and the markets will look forward to that. But there's this tension of like what may happen 6 months from now, but what's happening right now. And as the data comes out and kind of reminds us about what's happening right now, I think there's some risk to the market.
Yeah, I mean, look, I think this goes back to the difference in our worlds, right? Your world has kind of this linear trajectory, and the markets have a nonlinear path. And as we said 4 weeks ago here, we talked about, think about what could go right, not what could go wrong, right? From a sentiment perspective, so much bad news was priced in that you can have these massive rallies, which we thought we would have, and still not change that trajectory of what you're describing, right? So there is always that tension. That's why the markets are such a 3D mechanism, that you can't just look at the data. You have to look at kind of where the positioning of the data is in anticipation of what that data is likely to be as we go forward. Steve, let's shift it over to you with trade, but I want to first just ask about this Waltz move to the UN. Promotion, demotion, spin. Would it have happened had there not been obviously this what do we call it, Snapchat gate or whatever the hell? Yes, that's a signal gate, right? Correct. Just real quick on that.
Look, in Washington, I think there's a strong correlation between power and proximity. So if you're moving from the White House to the UN in New York, that would suggest to me a demotion.
Right. Particularly on the east side over there at the UN. I mean, one of the worst areas to be. I actually will not go into the city that third week of September. So if anybody wants to come in and have lunch or meet, I'm not going in. You can come out to Connecticut, that's fine, but it's a disaster when the UN's in session. I can't. Ugh, what a terrible place. I think it's a little bit of a
in more ways than one.
Yeah,
that's literal and figurative.
That is 100% on board. Let's talk about trade progress, Steve. Amongst our big trading partners, who's talking, who's not talking? Where are we with India? How's even the Ukraine deal, for that matter? Kind of what happened? Was it a win for policymakers this week, as you see it?
Well, maybe I'll just touch on the Ukraine deal first before we got to the trade. And look, I think it was a win-win for both the U.S. and Ukraine. I think there's going to be some time, and we'll see whether or not we can realize the potential, we being the U.S., from some of the minerals there. But anything we can do long-term to reduce our reliance on China for critical minerals, I think is important. And I think for Ukraine, while they didn't get the explicit guarantee that they may have been looking for, they're clearly going to get an implicit guarantee in terms of U.S. support moving forward, because clearly the U.S. is going to protect its commercial interests there. And that, because of the nature of the long-term process to try to extract some of these minerals, that also obviously reflects a long-term commitment there by the U.S. So I think that was an important win, and I would give kudos to Treasury Secretary Bessent. Obviously, he played a big role there. It sort of goes against something that Commerce Secretary Howard Lutnick said earlier in the week, where he basically said that Bessent's in charge of China, Lutnick was in charge of the rest of the world. I don't know that everybody else is on board with that statement. But moving towards progress on trade, look, we're recording this Friday, May 2nd, and we always have to put a timestamp, I think, now with trade and tariffs. But we have encouraging news from both China and the European Union with respect to trade negotiations. I think that's important because they were probably viewed as only two of the larger trading partners, but also probably the ones where the conversations are going to be most complex. So European Union actually sort of the trade commissioner putting out an opening offer, maybe it could be interpreted as that sort of, I think 56 billion in terms of increased U.S. purchases. And I think he's scheduled to come to the U.S. and continue conversations next week. Again, talking is better than not talking. Apparently suggesting too that one of the conditions from the European Union, and others have echoed this as well, is the removal of that 10% universal baseline tariff. So, I think that's sort of tied into the reconciliation package. We can table that, but I think that's encouraging. And then the thing that's really encouraging today is China. I think they're sort of borrowing a term that was used with respect to the Federal Reserve, sort of thinking about having negotiations here with the U.S. There's been a lot of he said, she said, pun intended there, with respect to, are we having conversations or aren't we having conversations with China? It's sort of a difficult spot. You can talk about, who are we going to trust more, Donald Trump or the Chinese Communist Party, to tell you the ground truth there. But I think just signaling now publicly that China wants to have these conversations is encouraging. It's going to take a long time to, I think, try to land that plane, if we can even do that. But I always say talking is better than not talking. And as part of that, I assume that you're not going to see any increased trade hostilities in order to create an environment for these conversations to occur at a minimum. And then maybe an optimistic case is sort of goodwill gestures where we start to see not only a relaxation of tariffs, primarily on the U.S. side, but maybe some other trade barriers that the Chinese have imposed on their side. And look, actions speak louder than words. I think we saw a lot of reports this week that while it's true that the U.S. is suffering economically too, China is clearly suffering well, and maybe more immediately. We see some of the reports there about the shipping containers, really the slowdown there. And then China actually putting forward a whitelist, a lot of exemptions there, sort of recognizing that, they rely on a lot of critical U.S. imports. So again, I think it's all just very encouraging.
And as you look at this, did they have a blink moment? Did we have a blink moment, or is it too early to say that either side blinked?
I mean, it's sort of a Rorschach test. If you don't like Trump, you're going to say he blinked. If, you sort of back the president and what he's doing, you're going to say, look, he's being practical and rational and taking some of these tariffs back. With respect to the auto tariffs that were announced, we got a rollback this week. And, I guess, from China, I'm sure they have domestic political considerations as well. That's why I think they're so eager to portray to their domestic audience that they're not the ones asking for the deal. That's where it gets to who's asking who. I know that sounds very much, we were talking about high school earlier in prom. It's more like middle school as to who asked who first. But again, for these leaders and their egos and domestic political considerations, that's not insignificant.
Yeah, for sure. Anything on reconciliation? What do you want to touch on in terms of what's happening here domestically with the House?
Well, it's really a situation what's not happening, and that was the House Republican leadership hoped to mark up the remaining portions of their package next week, but they were also the most politically complex portions. These were dealing with a lot of social sort of welfare programs. You have Medicaid and the Energy and Commerce Committee jurisdiction, as well as the SNAP program and the Agriculture Committee jurisdiction. And they need the Ways and Means Committee. They're the tax writing committee. They sort of are the ones tasked with a big portion of this bill, obviously, and they sort of have to wait for other committees to go first. And House Republican leadership hoped that they would mark these things up next week. That is now going to slip probably at least a week. And this just goes back to, we had these conversations on the budget resolution to unlock the process here. But the way that Republicans drafted it, they just avoided a lot of these difficult conversations. So I think moving forward now, you're going to hear a lot more as they're sort of putting pen to paper here on the details. Different policy proposals are going to be floated. And that's where you're starting to see reports coming out that Treasury Secretary Bessent was pushing for the inclusion of more business-friendly proposals that Republican lawmakers weren't planning on including. And every time you start to include something there, you have to find offsets, and then you have protected industries that are obviously going to be exposed to some of these things. So I know we've had a lot of tariff headlines. I think you're going to see a lot of tax headlines moving forward. The stated deadline is July 4th. That's obviously non-binding. I think an early, more realistic scenario might be before the August recess period. House is right now scheduled to adjourn July 24th. Keep in mind, though, that the real deadline is the end of the year. That's when some of these TCJA, the Tax Cut Jobs Act provisions of 2017 expire. And I think Republicans will eventually get there because at the end of the day, I don't think they want this $4 trillion economic headwind to come in the form of tax increases. That said, I think it's still going to be a bumpy path to eventually find that solution.
And what's at risk? I mean, I see the Defense Department spending likely to be increased. Is there really talk about cutting healthcare, Medicare, Medicaid?
So that's actually separate. We did get news out this morning that the White House is going to submit their budget request. And that's where you're seeing a little bit of a bump there for defense spending. And you also saw, even though I don't think we have the actual submission text yet, that the White House will not cut Medicare, Medicaid, or Social Security. It looks like the cut to that non-defense portion of the budget is going to be about $160 billion. That may correlate directly with about the $160 billion that DOGE is estimating that they could potentially save here. We'll have to see when the devil will be in the details there when it comes out, whether that's exactly where they pulled it from. But look, you have to remember that budgets are political messaging documents. While the president proposes, Congress disposes the cash. And I think at the end of the day, because this is a separate process through the appropriations committees, you need 60 votes in the Senate, and Republicans only have 53. That's why I'm skeptical that anything you really see released today is going to mirror where we end up eventually. My guess is where we'll probably end up eventually is just on another continuing resolution of the current funding.
Elon's been remarkably quiet. I'm sure that's on purpose. Is Doge falling flat on its face? I mean, is the $1 trillion number just so outlandish, and what we've seen so far, 15, maybe 20%, it's just not in the cards, or is this just government math and accounting, and there really is more savings there than what we see?
Well, I think with respect to Musk, you have to remember too, he was a special government employee. That was his status. So he only had 130 days to actually work there under that rule to avoid a lot of the disclosure and potential confirmation process that I assume he wanted to avoid. So you're thinking about what's really motivating his departure here. That obviously plays a big role in that. I've seen reports now about, Tesla wanting him to focus more on the direction of their company moving forward as well. So there's probably a combination of the two. With respect to what Doge promised to deliver versus what appears to be delivered at this point, I think it's just political reality. It's difficult to get into cutting trillions if you're not going to touch the actual entitlement spending that's driving a lot of that, with respect to the things we just talked about that Trump said in his budget request he's not going to cut, specifically Social Security, Medicare, and Medicaid. And in terms of how much government waste they were able to identify, perhaps there's still a little bit more, but I haven't seen as many announcements as that moving forward. Where the Doge may be able to make a longer, I think, imprint, maybe on just updating a lot of these outdated government systems, a lot of the wiring there with respect to the computing and not having the interoperability needed, and that may be underappreciated, and that may eventually lead to sort of a reduction in force if we can move to more automation. But at this point, I think it's safe to say they haven't lived up to a lot of the hype.
Yeah, for sure. Neil, when we talk about, and I know you've been in this soft data versus hard data camp, any update on that? I mean, is the soft data still softening? Is the hard data still hard, and are they converging?
Are you doing a commercial for Pfizer with this?
Easy. Oh my God. I hope we have the edit button ready to go. Here we go.
No, so I think, look, the to reconcile the survey-based data with the hard data, I mean, I think there's no like, it goes back to the instant gratification. I mean, consumer confidence remains weak. Consumers are still telling us that they feel worse about the jobs market. Their buying intentions for housing keeps going down. And the hard data, I mean, there's a bit of an inertia there. I mean, it's like, tariffs don't represent a sudden stop event, but they do represent a negative supply shock, which means the economy is going to slow down. So, for me, it's really just a matter of time. I think there's useful information in what the surveys are telling you. And I think they're useful in helping you refine a forecast. And to me, like, the most obvious place to see it is going to be in business investment, because you have really seen, like, capital spending intentions kind of fall off a cliff across a range of manufacturing surveys. And if that happens, and you start to see that show up in, like, core durable goods orders and shipments, then I think I'll feel a little bit better about how this is going to kind of play, like, sort of reconcile in terms of the data. Like, it's not good data, but that's I really look for it across three dimensions. And in terms of sequencing, I think it shows up in investment first, housing second, labor markets last.
And then within that, you got to think about, just from a CEO perspective, and your intentions on what you're doing. I mean, if there's that unknown, we talked about this, for the last 2 or 3 months now, the multiple on which you're willing to discount the future has to go down, right? I mean, there's just no way that you're willing to kind of price things to perfection if you've got these, kind of magic wand events.
Well, I think that there's so many different dimensions to this, right? Like, I mean, I agree with you. Like, I think that's another way of saying, like, the confidence genie is kind of out of the bottle, and how do you put it back in? It's really tough. Like, even though there's enthusiasm about deals, but those deals may not be final. So for firms, it's, is this going to really provide much juice to you to begin with? And then you're kind of back to square one, which is, then we're back to thinking about the tax cut bill, which is not that stimulative, and the regulation. And, like, there's a little bit of uncertainty around what that means for the economy. But to me, again, it just goes back to first principles, which is labor market conditions were slowing, and the Fed's not doing anything about it just yet. And that's probably going to be the case at least through June, most likely through July, but at least through June. So at least for another 2 to 3 months, you're going to see this sort of, this pressure kind of build. And, it's going to be interesting to see how markets respond to that when you do see that slowdown, because I do think it's likely.
Yeah, I was just going to mention, I think what Neil's saying was echoed by something that Secretary Bessent mentioned during the White House press conference. And he talked about President Trump using strategic uncertainty to what he hopes to be his benefit with a lot of these trade and tariff discussions. However, to Neil's point, that doesn't necessarily, when you're providing a lot of uncertainty that may benefit you on the trade and tariff side, that's obviously not going to be something that's well received by corporations looking to deploy capital.
Yeah, I mean, there's no doubt that I think one of the skill sets that politicians have is this multi-dimensional viewpoint, right? That if you press over here, you're probably going to see the results over there. And that might not happen in, say, the New York commercial real estate world, right? I mean, those things don't really exist, at least not to the extent that it becomes a lot more complex in the world of global politics, particularly as a sitting U.S. president. Let's talk briefly about the equity markets. Obviously we've had a rally. Our sense was that we'd rally to 57, maybe 5,800, the 200-day moving average. Our trend work still remains negative. So this is a tactical call within, a more strategic call. And again, we haven't seen that escape velocity for us that says that we've had the all clear. Our bullish tactical call was based on sentiment, and almost sentiment alone, and some signs of capitulation. And those, the reason that we engage in those is because they tend to allow you to play from a position of strength, not a position of weakness. What do we mean by that? If you're going to be bearish at 4,900, can you still be bearish at 5,700? A lot of people can't take that, particularly if you're performance-based. If you're a millennium pod, if you're a portfolio manager, even if you're an individual investor, you kind of feel that seductive power of the market, and the returns bring you in. And that's why we pay so much attention to the tactical because it allows us to play from a position of strength. We are invested up here. And so we at least feel like we can be more objective as to whether or not we want to chase, whether we want to let go, whether we want to add to positions and the like. So a couple things stand out to us right here. And again, this is kind of a fine tuning call. So take it for what it's worth. The sentiment environment that we had last week was actually as bearish, or it hadn't been as bearish as we had seen since November 2008. Now, anybody that believes that the economic conditions today resemble where we were in November of 2008 clearly doesn't have a good grasp on global finance. I mean, that's just not even close to being the case. What we were seeing, and I think this is still the case, is that the fuel in the tank that is driven by that sentiment allows you to have these big rallies that frankly just fill the void of a vacuum. And I think that's exactly what's taken place. We haven't seen that escape velocity, but at the same time, a couple things are happening that I do think gives us a little bit more fuse to burn. We talked about this on CNBC earlier this week, but I think you want to look at high beta. Beta continues to outperform. I think it's going to need to continue to outperform. And as long as it does, I think we're still in a good spot. I think you want to look at credit spreads. Credit spreads continue to improve and be stable. The 10-year yield continues to decline, or at least be stable. And again, that tends to be good news, not bad news. We're seeing this contraction in gold. So this idea that American exceptionalism is going out the window. We've talked about this on the pod. I think that's ridiculous. If you just look at the entrepreneurial spirit, the regulation, everything else, I get that there's policy uncertainty, but when you really boil it down into its essence, there still is a lot to be offered from American companies. And then I would, at the same time, look at the dollar has been able to stabilize. We've actually seen a decline in the price of oil. All these things set up. And if Neil's right, that we can expect sooner rather than later some type of cut out of the Fed, then all of a sudden those things that we were talking about a month ago, what can go right versus what can go wrong, start to add up here. So again, we haven't seen the escape velocity, but tactically we're still long, and we're looking for some of those divergences, Bitcoin to fail as an example, as an indication that maybe we're getting long in the tooth here in terms of what the market's offering. The one thing I would also note is we are very big on buying optimal entries near lows or bottoms. Really, you want to buy the market because it just doesn't really matter what you own. Obviously, you can own beta. That's a big move. But if you own the market itself, you don't have to worry so much about what sectors or parts of the economy you're exposing yourself to. Those oversold conditions that we also add just tend to be a little bit deeper in terms of giving you that snapback. And so that's why we recommend the optimal entries. I'm sorry, the optimal exits and the optimal entries at that point. Right now, this is the point where you transition. You've had a big move. What you want to look for now are those new names that are making relative strength highs. Those are your likely leaders as we go forward. The reason it's important now is because relative strength at a bottom is going to reflect just staples. It's going to reflect the defensive nature, low beta type of names. At this point, after we've already had the rally, you're not seeing things like Philip Morris. You're not seeing things like Clorox make new relative strength highs. You're actually seeing it in these other select industries. Clients will know what that is. If you want to be a client, you're welcome to it. And those are the ones that we're leaning on because they're likely to be leadership as we go forward. So that's how we're thinking about the market here. Let's move on to the mailbag question. Our own Harry Chen has our mailbag question for this week. Harry, you're up.
Okay, today we have the question from Cliff Conwell. His question is, long-time listener, first-time caller, question primarily for Neil. What so-called leading economic indicators are you watching most closely today to explain where the economy is in terms of real GDP growth? Which leading indicators are not working in today's environment versus historical environments? And how does that explain the world economy we are living in today? I.e., if we are in a stagflation, rolling recession, etc. Thank you.
All right, Neil, you're up.
Well, it's a great question. I mean, those of you that follow my work know that I'm not a big believer in indicator macro. right? I don't believe. I mean, the big flaw with indicator macro is that it assumes that relationships are kind of stable from one cycle to the next. So, whenever you see analysis like never before have we gone into recession with the ISM this low before. I mean, I think that's kind of useless. So to me, it's like really what I'm looking at is, and as I say, like there's no, I don't think there's a one hot indicator. There's no holy grail statistic that gets you the right call every time. Not even the yield curve. I mean, as a lot of people have kind of found out the hard way in the last couple of years. But what I do think is important right now is really, housing. I think housing is interesting. The fact that unsold inventories continue to climb and what that's doing to home prices across the country, particularly in the meat of the market, and what that might mean for residential construction jobs going forward. We're also, as I mentioned, looking at investment spending in particular, especially because in the first quarter, we had a very big boom in investment spending. It's hard to see why that lasts. I think a lot of that was front running of tariffs. And we're focused on the jobs market. Everyone talks about how the job market is a coincident to lagging indicator, but there is interesting information within the employment report that kind of helps set the tone for the near-term data flow over the next few weeks. Like as an example, this morning we saw manufacturing hours worked contract fairly meaningfully over the month. So that means that when the industrial production data are released, sometime in the next 2 weeks, you should expect to see a big decline in factory production. And that's going to have implications for things like the Atlanta Fed GDP tracking estimate that everyone looks at. So, like I would say, there's no one holy grail indicator. And if you're doing your job right, in my case, which is like trying to frame an outlook, your outlook should be the best leading indicator, right? So that's sort of how I think about it. There's not one hot indicator, and everyone's always looking for a hot indicator. It doesn't exist. It's about your judgment. Your judgment should be the best leading indicator.
Yeah, I would add to that. And Cliff, I don't know if your question is more on economics or economics as it relates to the market and making money. Obviously, that's what I do. The market to me has always been one of the best leading indicators, and not just what are stocks doing, what are bonds doing. I mean, obviously there's something to that, but even the nuance within that, what is happening to the quality factor within equity markets, what's happening to momentum within equity markets, what's happening to staples versus discretionary, what's happening to utilities versus financials. All of those things tend to have a pretty consistent rhythm to them. But just like Neil's world, in terms of the overall economic data points, it doesn't end up being just one of those indications. It ends up being several of those. And so putting those together, kind of creating this mosaic, really ends up being important from a equity market perspective on what the economy is telling you. Now, today, I think one of the things that's really most encouraging, even though the equity markets in the U.S. have been weaker, and as I mentioned, trends have turned negative, that's not the case in China. That's not the case in Europe. It's not the case globally in financials. Financials are actually part of the whole leadership continuum here globally, which is not something you'd expect. And we just talked about sentiment. If we were in a November 2008 environment, financials were nowhere near leadership, right? So it's really putting those things together and looking at the market's message. What's the market telling us collectively with the wisdom of dollars invested, what is happening and what's the sustainability of that? And I think that's an important message to take away, that it's not all dire. And we talked about the credit spreads. Credit spreads are actually not suggesting recession. If there's anything that I think the Fed might be looking at that says, hey, maybe we don't want to be premature here, it's credit spreads in my book, because the credit spreads are not suggesting that we've got some cliff event that's taking place and some deterioration in the funding costs that help to drive the overall economy. All right, a lot going on this week, so let's talk about next week. Neil, what's on the docket next week? I know this is kind of a big week for you, so it tends to soften next week. What's happening?
Well, we have the Fed meeting next week. So we'll see what they say. I mean, no one's expecting them to do anything. I think that's the right call. An interesting question to ask Powell would be, if there wasn't a tariff threat, how would you be thinking about May? I would love for a
Did you hear that, Steve Leisman? Did you hear that, Steve Leisman?
I would love for a reporter to ask him that question, because, you know, I think there's, frankly, you know, average hourly earnings are slowing, right? So if you assume that productivity is like 1.5 to 2%, and you're barely growing like 3% average hourly earnings, I mean, you're right there in the strike zone for the Fed's longer run inflation target. So it really begs the question as to, you know, I mean, if tariffs weren't there, would you be cutting? That should be the first question a reporter asks. And yeah, that's really it. I mean, we got ISM services, but no one cares about that now that the job numbers out. But we'll see. I mean, it's just another piece of soft data that we could keep an eye on.
Right. Steve.
I'll be watching to see if President Trump says anything after or during Fed Chair Jerome Powell's press conference on Wednesday. He's made his opinions about Powell well known, even though he plans to keep him around. But I think at this point, just seeing Trump's reaction to anything Powell does or says will be something to keep an eye on. Beyond just some of the topics we mentioned earlier, you know, will Republicans make any progress towards resolving some of these thorny issues there on the House side? Even if they do, remember the Senate is very far away. So I think it's going to, again, take a while to address some of those issues. And then on the trade front, you know, we have encouraging signs as of Friday with respect to China and Europe. You know, hopefully that progress continues to go in the right direction next week. But there's always something to keep an eye on there on the trade front.
Right. Certainly from our perspective, we're going to continue to watch for divergences in this tactical rally that we've seen. We're going to look for kind of this capitulation, if you will, from the bears to move decisively into the bull camp. Just keep in mind that's going to happen on good news. That's not going to happen on bad news. That's why this, again, is such a 3 to 4 dimensional chess game that we play every single day. But looking for those divergences, softening of the beta trade, rallies in gold, weakening of the dollar. All those will be important. But as we stand right here, again, looking at the relative performance highs, we're going to be looking for what industry groups, what theme is developing from those new relative strength highs, because again, that narrative is likely to be driving the next bull phase for whether it's these companies, these industries, or even the market. And that'll certainly be important to watch from here. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter, and you can subscribe to our YouTube channel under RenMac. Until then, happy Derby Day, guys. Good luck with your, hey, by the way, don't bet my horse, okay? Because I want my odds to stay where they are. So, you know, let's go easy on that. Swinging those dollars around there, Neil. I know how you like the ponies. Anyway, have a great weekend. We'll catch you guys next week. Thanks for joining us.